A warm welcome to this new series where we're going to be spending a little bit of time together testing out some of the most popular trading strategies that you can find on YouTube. Each video will see us take a new popular strategy with a claimed high win rate, we'll code it up, backtested over thousands of trades whilst making sure to include things like spreads so the tests are accurate. I'll show you the code and the results, and to rack up the tension we'll also keep a running score of the good versus the bad. So without further ado, let's jump into the first strategy and see if it's a winner or a dumpster fire. So first up is trading with the trend, the best scalping trading strategy for beginners, how to scalp Forex, stocks and crypto. Very popular video with over 500,000 views. A quick glance at the comments seemed to suggest that overall the strategy had been well received, although I did notice that one of them was a little bit less happy, having done 10 trades and lost 8 of them. I'll put a link to the video itself in the description so you can actually check out the raw footage. The setup looks a little bit like this. There are essentially 3 indicators on a price chart. The first one of those is the EMA 200. The video claims that if the price is above this, then we're in a positive trend, and if it's below it, we're in a negative trend. Then we have the RSI, which is 9 periods added to this, and finally we detect engulfing candles, which are the light blue candles you can see on the chart here. The video explicitly says that we should be looking for buys only, no sells, and we buy if the price is currently above the EMA 200 and the RSI is greater than 50, and if both of those are true and we have an engulfing candle, then what we're going to do is we're going to enter the trade at the close of that engulfing candle. We'll set our stop loss at 2 times the size of the body, and then we're going to set a risk to reward of 2 to 1, so therefore the take profit is effectively 4 times the size of the body in the other direction. The video itself is extremely clearly presented and really well done, and indeed is very good material for a beginner to understand. At one point during the video there is the quote saying that this strategy has been backtested and proven to work. So the question I wanted to know when taking a look at this, and I'm sure you do, is this actually a dumpster fire? Well, the answer in short is yes. To give you some highlights of the results, I initially set this up from January 24 till April 24, so 4 months of testing. Initially I did the M5 candles, classic scalping, got depressed with the results there, tried the M15, that was also pretty bad, tried the H1, that was also bad, all done on a 2 to 1 risk to reward as recommended with the video. To give you an overview of just how bad it was, we can flick here to the M5 results. You can see that over that 4 months, most of the accounts will have been long since blown, probably in the middle of February. It doesn't get much better when it comes to the M15 results, either simply less loss because we have fewer trades. There's around 150 trades per pair here. We had around 300 to 400 with the M5s. The story with the H1 isn't much better either. Again, reduction of trades, therefore reduction of losses. So to answer the title of the video, is it really the best beginner strategy? I'm not sure, but I could be wrong. Therefore, what I'm going to do now is take you through the process that I went through to actually code this up and backtest it. When it comes to doing backtesting, I tend to take a sort of Hunger Games approach to things with strategies. There are 3 steps, starting with the orange box. This orange box is some quick and dirty code, usually in a Jupyter notebook, takes anything up to 30 minutes usually, and already 99% of the strategies die here. The particular strategy in question for this video actually took 6 minutes. I timed it to code up and didn't make it to the blue section. In the unlikely chance that something does make it to the blue box, I usually spend an hour or so refining the code, making it faster and putting it inside a script where I can test a load of pairs. On the extremely small chance that that's successful, then we go into some rigorous testing where I usually spend another 3 to 4 hours or so building up something with a database where I can save results, put multi-threading in there, and go ahead and test a good 10 years of data with different parameters and things like that to really understand what the potential is. Usually I'll also include things like Sharpe ratio and drawdown inside here to get a good flavour of the results. So if you're interested, what we're going to do now is dive in and take a look at the code that I wrote to actually backtest this, so you can also make use of this kind of code yourselves if you would like to. In terms of the code, there are 2 main aims really. The first one is to get the numbers inside the code exactly the same as TradingView so nobody can complain. The second one then obviously is to take this data and then test it. So I'll very quickly take you through the code that was used to make this backtest. If at any time you need to inspect it, obviously you can just pause the video and take a look. We don't have anything really special inside here. We've got pandas, NumPy, and also pandas TA. Usually on my courses, if you've ever done one, you'll know that I don't recommend using pandas TA or indeed any indicator library. I like to write them myself, but in this case it did give the same numbers as TradingView, so I was happy to use it. Then we have a couple of custom classes which I use for plotting and also for loading data. When we load the data, we get a price data frame with, you'll note, the mid, the bid, and the ask prices. An accurate backtest only comes by using the spreads, so we're going to enter our buys at the ask and exit at the bid, and vice versa for a sell. Too many times I see backtests using the mid prices, which is completely inaccurate and too optimistic, and even worse, often just using the close price of a candle instead of taking into account the highs and lows. With the data loaded, we calculate then the technicals, which is fairly simple. I've added in some comments onto the code here. There's nothing particularly special to note. The main objective was to run this code and then check the numbers off against TradingView to make sure they were identical. And the good news was they were identical to what was on TradingView, so I was happy that we could go ahead with the simulation. One last step I like to do before simulating is often print out some of the trades or the signals so we can check visually with the stop loss and take profit that everything's all right. A cursory glance at some of the trades that were pumped out seemed to suggest everything looked okay, so I was happy we could go go on with the simulation. So when I'm doing the backtesting, what I usually like to do is have a trade class. If you've done any of the courses, and you'll know this is usually how I like to build things up. It does seem a little bit like overkill, but there is a reason behind the madness. We take in a row here, which is a data frame row when we have a trade, and we simply store a load of information from the row, which we can then use later on. Once we set up this information, as we walk through the trade, we update the trade with every row of the prices. So what we do is we check whether the bid low has gone below the stop loss. If it has, then we've stopped out and we score -1. The risk to reward, remember, is 2 to 1. If the bid high exceeds the take profits, then it's the other way around. We've got a score of 2 because risk to reward 2 to 1. And also we set the end prices of the bid high and the bid low so we can verify this later on. If we did close the trade, then we set is open is equal to false, and we also set the ending time and the index in the original data frame so we can reference them later on. Finally, last but not least, there's a toDict function here which simply returns a dictionary with all of the main information. What we'll do is make a list of these trade dictionaries and we'll turn these into a data frame so we can inspect the data when the simulation is finished. So with a drum roll then, we've actually arrived at the point where we can run a simulation, and the code to do this is surprisingly short. So we simply define a pair, euro US dollar, a granularity, which in this case can be the H4 candles, so the 4-hour candles. We'll load the data from a file, or I will. I have an archive of data going back to about 2010. We'll load this from 1st of January 2024. The data itself goes up to about the end of April in 2024, I think. We'll then add our technicals as we did earlier. Then we'll get our list of closed trades. What we'll do then is get our trades themselves, iterate through the trades, grab the row, set up a trade, and then from the following candle onwards, what we can do is update our trade until it's closed. When it does close, we'll append it to the closed list and we'll append the dictionary. That means then we can make our data frame of our trades, which we can inspect later on, sort them according to start time in ascending order, and last but not least, print all of our wonderful gains. So let's run this on the 4-hour candles. It'll be very quick, indeed 0.2 seconds. So we found that we made 16 trades and we lost 4%. Well done. Now before doing anything else or shouting or screaming at the screen, what we should do is take a quick look at the trade's data frame just to make sure that the data looks like it's making some kind of sense. If we take the first trade, we can see it started at index 92. The price was 109591. The stop loss, does it look sensible? Yes, it does. It's way below the start price. Then we can see we ended at index 104. That was quite a bit later. It was on the 12th of March. The trade originally opened on the 8th of March. Hit stop is set to true, so we know we hit the stop loss, and we can actually have a look at the price that caused the triggering, and that was definitely below the stop loss. Therefore, everything looks okay there. I would like to see a win on here, but there isn't actually a win on here at all. So what I'm actually going to do is do head 10 here and just see if we can see actually a winner. We do. We have one winner here. We didn't hit the stop loss, which is good to see. We've got +2 points, which is also good to see. The take profit was 108,411, and we can see that the closing price or the end price definitely exceeded that, so we did exit the trade correctly. In terms of this one, the starting price 08223, and the stop loss was set below this. So I'm pretty sure from what I can already see here that things are more or less okay. If we're feeling particularly masochistic, what we could also do actually is plot the cumulative gains as well throughout the test. So I'll make a cell above here, drop some code in here to do that, and let's have a look at the cumulative gains. And we can see that we lost quite a few in the row before doing a bit of a recovery and then losing it again. However, this was on boring H4 candles, which nobody's really interested in because remember, we're scalping here. So let's take the M5 candles in this case and run this again. And running that again drops us out in 1.8 seconds, not bad, 396 trades and a whacking gain of -207%, not bad. Let's have a look at the graph for this one, and there we have a lovely consistent line, which if we inverted would be making a lot of money. Unfortunately, we can't invert it, it's losing a lot of money. Now, I don't really want to bore you with showing you too much more of this, but another couple of examples, just in case you're interested. Let's have a look at the US Canadian as well, so you get an idea of how quick it is to be able to test these. 373 trades, 169% loss, very nice. Let's try one more, shall we? We'll do the GBP and the US dollar. This one as well, I guess, is going to be fairly negative, and it is -158, 371 trades. So in reality, despite my best intentions to test these as thoroughly as possible, it's already clear there is no point in going any further with this one. Before we finish, however, in the interest of balance, what I've done in that transition that you just saw is actually modified the code very slightly. I've gone and taken out the spread and put in the mid prices everywhere, because I know that people get very upset when we have to be realistic and actually use the spread. Therefore, what I've done is taken the spread out of the strategy and also inside the trade class changed it to the mid prices as well, so that we're looking at the mid prices and not the bid prices. I'll say again, that's completely unrealistic. Everybody has spread inside their trades. Nevertheless, I know that people get upset by bad results. So let's run this again then with the US Canadian and the M5 for a little test here. And what we can see is that we have a gain of +3%. Wow, so this is as good as it probably gets. Again, it's completely unrealistic. And even then, when we run the chart to actually have a look at the gains and the losses on here, we can see that we ended up at 1 point 30-something% down on the accounts. Not bad. And that is with no spread or no fees or anything. Let's just do one more to labour the point and then we can finish, can't we? So let's run the pound and the US dollar, and that gives 4%. And let's see how pretty the chart is with this one. And again, same old story. We end end up losing nearly 10% of the account, actually very, very quickly on the left-hand side here. I suppose what we could do is just verify things maybe with a slightly longer granularity where maybe things are better. They're not. We've lost 19% on this particular one here. Let's go to H1 candles and see how we are now with hardly any trades. Oh, we've got 31 trades and a 2% gain. Let's see where we are, all over the place again. So even when we make the strategy artificially positive by taking out the spread, it's still no good. Before we finish, I'd like to remind you of the quote right at the start of the video presenting the strategy in question, saying that the strategy has been backtested and proven to work. Now this may well be the case. It was a bit different in my case, but I could have got things wrong. So as always, please make sure you do your own testing and verifications before you use real money. So as far as this series goes then, we're at a score currently of good 0 and bad 1, I would say. So if you enjoyed this video and you like being pestered by notifications, then please feel free to subscribe. If this video enraged you and you're convinced the strategy is actually correct, then there's probably no helping, so never mind. Good luck to you anyway. And if you'd like a strategy that you're interested in testing, then by all means drop me a note in the comments or come into the Discord and mention it there. Otherwise, see you in the next one.